Okay, guys, I hope you people are doing well. Welcome to this session. The whole agenda and whole objective of the session is to conduct a revision for the AFM for the September 2023 examinations. Now, what is going to be my agenda for the session of today? My agenda for the session of today is going to be that I shall be taking you through the different areas of the AFM, and I would try to do the examination questions. That's what my whole objective is going to be. So I've actually compiled a list of examination questions, which out of which obviously all the questions won't be doable in today's session, but obviously we can do a certain number of questions to just kick off the things for the AFM revision, for the AFM preparation for the examinations of September 2023. Now, before I proceed, a lot of you people know me, but in general, if somebody who doesn't know me, my name is Luqman Rafiq. I have been in teaching profession for more than 13 years now. I have been teaching different courses for different qualifications, including the financial reporting and financial management and the performance management courses. So we're gonna start off. I'm not gonna waste a lot of time of you people, and thank you for you people to have been kept you waiting for some time. But anyways, I'm just gonna start off. I've taken out some questions from the past examination papers. I've used the Kaplan revision kit to extract these questions, so I'll be using the Kaplan revision kit extracts. The handouts have actually been shared with you people in the WhatsApp community. And just for the sake of you people, I'm just going to share the link of the community again with you people. Just in case if any one of you is not part and parcel of the community, you could become part and parcel of the community by using this WhatsApp link. I'm just going to share the link with you people. Okay, you're most welcome to ask whatever questions that you might have. I'll be happy to answer them. Don't worry about asking, just keep on asking. There's no such thing as a stupidity. There is always a room for asking whatever questions that you have, because what is important is clarity. The fear of being thought of as a stupid person should be taken out, and you should think about clarity, and you should think about passing the examination. Before I proceed, I would like to ask you people, if you have got any questions to ask, you're most welcome to ask, or else I'm going to take things forward. Yeah, if any one of you has got anything to ask, you can ask, or else I'm going to take things forward now. So let's just start off, guys, with this AFM Revision Marathon. I have already shared with you the handouts for the revision marathon. We have had a bit of an introduction about myself and what the agenda of this session is going to be. So let me just take you people through some of the examination questions, and we can then have as many questions as is required as we move through. So let's just start off. The first one of them is about the Zichi company. This is one of the past examination question. What I will do is that I will take this question through with you people. We will read through the question, and then we would start discussing whatever queries that you might have with respect to this specific scenario. So when we talk about the Zichi company, let's just start off. Let's just start discussing. It says Zichi company, the following exhibits available on the left hand side of the screen in the CB examination. Obviously, you know, when you go to the CB examination platform, there is a screen, and then on the left hand side there are different exhibits that you open up. I won't be doing the question on the CB platform because not all the questions are updated over there. Plus, I want to make sure that I make the answers available to you people through the Excel file. So when I do the question on the CB practice platform, I cannot make the answers available to you through the Excel file. So I want to make the answers available on the Excel file to you people. So let's start off. Let's take things forward. Basically, it says that the following exhibits available on the left-hand side of the screen provide information relevant to the question. So you've got a Zichi policy failures, you've got new project discount rate, you've got new project cash flows, you've got financing the new project. These are multiple things that are there. So we're going to talk about each one of them one by one, that what exactly are these things all about. It says the information should be used to answer the question requirements within your chosen response options. So the information should be used to answer the question requirement within your chosen response option. Before I go on to go through the question, I would just like to have a quick discussion of the requirement. That what exactly are the requirements? The first requirement is it says discuss and justify the actions Zichi company should take to address the three financial strategy policy failures. So there are three strategy policy failures that have actually taken place, and they would want you to tell them that what actions should be taken. Prepare a report for the board of directors of Zichi which estimates an appropriate discount rate to use to determine the net present value of the new project based on all equity finance. You would remember that when we talk about all equity finance, that means simply we are assuming that the debt of the company is 0%. We're assuming that the debt of the company is 0%. That's what we are assuming. The second thing is that when we talk about the all equity finance, there is something else that you need to understand, and that is basically um, estimates the value of the new project based on all equity finance. When we talk about all equity finance, so that means we are simply talking about the APV. We are simply talking about the adjusted present value. Estimate the net present value of the new project, assuming that it is all equity finance. This is where the APV is all about. Estimates the adjusted present value of the new project. Okay. In fact, sorry, I would say it's a base case NPV. Evaluate whether the new project, when the word says evaluate, evaluate means discuss, that whether the new project should be undertaken, and discusses the assumptions made in the estimates above. Discusses whether the adjusted present value method would be more appropriate than the conventional net present value method to evaluate the new project. That's what it is. It says professional marks will be awarded for the demonstration of a skill in communication, analysis, evaluation, skepticism, and professional and commercial acumen. I would talk about each one of them one by one when we go about it, that what are these professional marks. But first of all, let's actually start discussing about some of these policy failures. The approach that I'm going to adopt is that um, I would actually be discussing these things with you people, and the approach that I would be adapting is like this. I would say, like it says Zichi company's policy failures. So these are three policy failures. You have the requirement of the question in front of you, which is discuss the, what is the requirement of the question, which is discuss and justify the actions Zichi company should take to address the three financial strategy policy failures, right? That's what it is. So I've written down the first specific thing. And what I would want you people is that to take 5 minutes time, just try to do this part on your own, and then we are going to take things forward. So we've got Zichi company policy failures, just talk about it, and then we are going to start discussing. Just review it, then we are going to start discussing. Yeah, can you just go through it? Then we'll start discussing this part. Yeah, try to write down some pointers on it. Try to write down some pointers on it. Yeah, try to write down some pointers on it. Okay, this is really good to see that there is an input from Faraz. Faraz, thank you very much for this input. This is really good to see the input. Kindly just allow me a minute just to fix something related to this camera. Just allow me a minute, please. Okay, guys. So let's just start off and let's discuss about this policy failures that are actually mentioned in the scenario. The first thing that we have is it says that Zichi company is a large. Zichi company is what? It's a large listed engineering company involved in the development. Okay, guys. So with respect to this Zichi company, it says Zichi company is a large listed engineering company involved in the development and manufacture of environmentally friendly products for businesses worldwide. Until a few years ago, the value of its shares had been increasing steadily and it regularly outperformed its main rivals. So, what did it do? It regularly outperformed its main rivals, right? That's what it did. Now, what next is there? It says, however, more recently, its shares have been underperforming, and many financial analysts are recommending that Zichi company's shares should be sold. Zichi company's investors are becoming increasingly concerned. So the investors are becoming increasingly concerned. Why? Because a lot of financial analysts have been suggesting that your shares are underperforming and they should not be kept, they should rather be sold. The analysis concluded that this underperformance was due to three policy failures in the company's financial strategy as follows. So there have been some policy failures which have been existing and they have been the reason for the company's disaster. Now it says the company does not undertake post-completion audits of its investment projects. So whatever investment projects that have been completed, they don't undertake the post-completion evaluations, number one. Number two, the company uses fixed discount rate of 10% to assess all investment projects for some years now. None of the company's senior management can remember why this rate was chosen. Okay, so they have just adapted 10%. Maybe everybody loved 10%. So they've just adapted the 10% and they just continued with that. And Zichi company has continually funded new investment project using equity finance. And the analysis concluded that this financing strategy sent the wrong signals to the investors. So basically, what was the question's requirement? The requirement of the question was that you were supposed to discuss and justify the actions of Zichi company should take to address the three financial strategy policy failure. So you have to discuss the actions that should be taken and you have to actually justify that why those actions should be taken. That is something that you would have to do. So let's just start off, let's just start going through it and let's just start discussing about it. So the first one of them is Zichi does not undertake post uh, Zichi undertake does not undertake the post completion audits, right? That's the first issue that's happening. Okay, let's just start off. Let's just start discussing. Now, basically, when we talk about this thing, the first one of them is it comes about the post completion audit. I would just review one of the students, Faraz. He has suggested something. He says post completion necessary to assess whether the agreed outcome or objective is achieved or not. Faraz, good enough, a very comprehensive pointer. But just to make sure, let's say basically what happens is that you have to just draw a bit of a context that see, when a project is undertaken, whenever a project is undertaken, what actually happens with respect to the project is that, I repeat, whenever a project is being undertaken, what happens with respect to the project is that um, the with respect to the project, what actually happens is that there are certain estimates involved. The estimates are involved with respect to the cost, units, selling price, expenses, etc., etc. Over time, estimates change. The circumstances, they change. So what happens over time is that the estimates, they change. The circumstances change. So as a result of this, what is needed is that a post completion audit identifies what? A post completion audit actually identifies um, the differences that arose, helps improve estimates for the future projects, help improves the estimates for the future projects also. So that's what happens. So number one of them is that they don't undertake the post completion audit, and when they don't undertake the post completion audit, this is actually going to cause an issue. This is actually going to cause a problem. Number two point is that they've used a fixed rate of 10% to assess all investment projects. Thanks Faraz again for your input. I'll just talk about the discount rate. Okay. Now let's talk about the impact of discount rate. When we talk about the impact of discount rate, what is it? Basically, the discount rate reflects the risk. Use of fixed 10% rate is inappropriate. Each project has different risk. So let me just repeat that each project has a different risk. You see, what happens is that every single project has got a different risk. And what happens is that discount rate should reflect the risk attached to the project. If 10% is higher, would lead to rejection of profitable projects. If 10% is lower, it would lead to rejection of, it would lead to acceptance of loss making projects, right? So basically you just need to understand this thing, that the concept is like this: whenever you have a discount rate, the discount rate should be adjusted to reflect the risk which are involved in a business. I repeat, the discount rate should be adjusted to reflect the risk involved in a business. If you don't if you don't adopt a proper discount rate, that means you are going to be either accepting a project which should have been rejected, or you would have been rejecting a project which should have been accepted. That's something that you would be doing. The next aspect is basically called has continually funded new investment project using equity finance, and the analysis concluded that this financing strategy sent the wrong signals to investors. So use of equity finance to fund the projects. Now, debt finance can also be changed, but required return for equity investors might also change. Okay, projects prevent it's are mostly cheaper than need to fund out. Okay, now see what happens is that um, entities prefer funding using internal source. So a lot of entities, what they would do is that they would prefer the funding using the internal source. So entities, what they do is that they prefer fundings using the internal source. However, uh, continuous use of internal funds has an impact that equity has higher cost involved. What actually happens is that the equity has got higher cost involved. That's number one thing. Number two point is that the equity has got higher costs that are involved. That's number one. Uh, reliance on equity would indicate lack of ability to borrow funds. So what would happen is that it would actually indicate the lack of your ability to borrow the funds. That's important thing. The third thing is that So these are the few pointers that you would probably be mentioning with respect to all of these issues that have been identified. So you would have to actually mention these things when you would be talking about these different projects, that okay, why is something suited, why is something not suited. So that is what it is going to be. So just let me know if you people are okay till now so that we move on to the next part of the question. So I've just mentioned a few of the pointers for you people so that you people have an idea that okay, what's going on, what's actually relevant, what's actually not relevant, right? Okay, um, good enough. So I think let's move a bit forward and let's discuss a bit further. Let's move on to the next part of the question. What is the next part of the question? It says, prepare a report to the board of directors of Zichi which estimates an appropriate discount rate to use to determine NPV of the project using all equity finance. So you have to estimate the discount rate. The second thing is that what is it that you have to do? You have to estimate NPV using all equity finance rate. You have to estimate APV of the new project. Let's just start discussing. Let's go about it. There we are gonna go through the question. We're gonna list down the key information, and then we are going to move forward. Let's talk about the key information. It says Zichi company is considering a new project to manufacture environmentally friendly motor scooters which are fully carbon neutral. So they are considering new project to manufacture environment friendly motor scooters which are fully carbon neutral. This is a diversification into a new business area for Zichi company in which it has no previous experience. Zichi company's financial officer is of the opinion that Zichi company should determine an appropriate discount rate for the project based on an initial assumption that the project will be all equity financed. Okay, so they are assuming that the project is gonna be all equity financed. Can you just suggest us an appropriate discount rate? Okay, let's go. Liu company would be a competitor to Zichi company. Okay, so there is a company called Liu that's a competitor, as it manufactures environment-friendly motor scooters as well as equipment for wind farms. Approximately 60% of Liu company's business is manufacturing motor scooters. Remaining 40% is manufacturing wind farm equipment. So Liu is a competitor, but the problem with Liu is that they've got multiple business. They don't have a single business. It says given below is the most recent financial information relating to Liu company. So you're being given the most recent financial information relating to Liu company. The share capital is given. The reserves are given. The market value of equity is given. Market value of debt is given. Equity beta is given. That's something that's given. Sen New company is involved in the manufacture of equipment of wind farms. So they've talked about another company. It has estimated its cost of equity as 15.4% and is financed this and this by equity and debt. Estimated risk-free rate is this. Market risk premium is this. Corporation tax rate applicable to all companies is this. Okay. So we now have got the information, and what we are going to do is that we're going to talk about this whole thing, and we're going to see that how to actually do the things. Now, first of all, let's just start discussing, let's just start going through the things, that what things are going to be. The first thing that you need to understand is that when we talk about the all equity rate, when we talk about the all equity rate, how exactly do we get the all equity rate? Let's actually talk about that. When we talk about the all equity rate, so simply there are multiple ways, and one of them is you use the capital asset pricing model. With the capital asset pricing model, you've got the formula KE is equivalent to risk-free rate of return plus equity beta multiplied by RM minus RF. Now, so when I talk about all equity rate, so for the all equity rate, what we do is that we actually okay, for the all equity rate, what we do is that instead of equity beta, here we use asset beta. Instead of equity beta, what do? We use the asset beta. We do the asset beta. Now, so basically the capital asset pricing model, the cost of equity is risk-free rate of return plus the asset beta into RM minus RF. That is what the all equity rate is going to be. Now let's just start discussing and let's take things forward. Now what next is there? So that means we would be needing the asset beta. And before we go on to calculating the asset beta, let's have a quick recall of the betas. So you know that the betas are of three types. First of all, what a beta is actually a risk coefficient. I repeat, the beta is actually a risk coefficient. And amongst the different type of betas, what actually happens is that one of them is asset beta, one of them is equity beta, one of them is debt beta. Or I would rather say one of them is asset beta. So when you talk about the asset beta, the asset beta is simply what? The asset beta is simply your business risk. Your debt beta is simply your financial risk, and the equity beta is simply your business risk plus financial risk. Equity beta is simply your business risk plus financial risk. That's what equity beta is. Now let's have a bit of a discussion about each one of them, that what these betas are and how exactly are the things going to be. So you know that these betas are connected, and you get the formula in the examination also, that these betas are connected to each other through this formula. And generally speaking, we assume the debt to be having a negligible risk. Therefore, the debt beta is assumed to be zero. Therefore, the debt beta is assumed to be zero because we assume the debt is actually the debt is actually what? The debt is actually assumed to be having a negligible risk. Now, so how would you go about having the asset beta? The asset beta is equivalent to equity beta multiply market value of equity divided market value of equity plus market value of debt 1 minus t. So this is what the formula is. Now, if I move a bit forward and if I tell you something, so here what is actually happening is that we are Zichi company. Our proposed investment is in motor scooter. With respect to motor scooter, what is actually happening is that I paid with respect to motor scooter, what is actually happening is that we have got one company which we know. The name of that company is Liu. Liu company. And Liu has got two businesses. What are those two businesses? The two businesses that Liu has got is motor scooter. Another business that Liu has got is wind power. So what is simply going to happen is that the asset beta of motor scooter business is going to be estimated and it would be used for Zichi. But for us to use the asset beta, we need to have the asset beta of the wind power, and for us to be able to calculate the asset beta of wind power, there is another proxy company that needs to be used, and the name of that company is San Venue company. What is it? That's actually San Venue company. So this is how the approach is going to be. So when the question's requirement is that you have to estimate the all equity rate, I mean, when the question's requirement is that you have to estimate the all equity rate, this is how things are going to be. So let's start discussing few things. Let's just start discussing few things because we now have an idea that what exactly the things are going to be. So we are gonna just discuss things and you're gonna see that how these things go about. So first one of them is basically Zichi company. Estimation of all equity rate. There is an estimation of all equity rate. First of all, we have the information of Liu company, right? We have got the information of Liu company. So the Liu company, you're being given the share capital, you're being given the reserves, the market value of equity, market value of debt, equity beta, so and so, so and so. Relevant information of Liu company. Market value of equity, market value of debt, equity beta, the tax rate. So 172 million is what it is. 48.26 is the market value of debt. 1.2 is the equity beta. 20% is the tax rate. Okay. So if we have to calculate the asset beta, the information that we would be needing is that D1 minus T is what is needed. So it's actually going to be D into 1 minus T. Then we need E plus D1 minus T. E plus D 1 minus T is what we would have. So if we talk about the asset beta, what is it actually going to be? The asset beta is simply gonna be the equity beta multiplied by bracket open market value of equity divided by market value of equity plus market value of debt 1 minus T. Kindly look at it. What have I done? Kindly look at it. So 0.98002 is the asset beta. I bet 0.98002 is the asset beta. Asset beta for what? Asset beta for Liu company. Now what next is there? Yeah, the debt beta is assumed to be 0. Now, so we know asset beta of Liviu company is equivalent to 60% of motor scooters, 40% of wind farm. 60% into asset beta motor scooters plus 40% into asset beta wind farm. So the asset beta of Liviu company is actually made up of this. Now we need to actually, we know this asset beta of Liviu company, which is 0.98, but we don't know the asset beta of wind farm, we don't know the asset beta of motor scooters. So what we would do is that we would calculate the asset beta of wind farms first, because we have a proxy company. Proxy company is San Van Yu company. They have a cost of equity of 15.4%. San Van Yu company. KE is equivalent to 15.4%. Debt is 20%. Equity is 80%. Then what actually happens is that you have got the 20%, you have got 80%. The risk-free rate of return, the market risk premium is the tax rate is given. So you've got 20% tax rate. The risk-free rate of return is what? 4.8%. The market risk premium is 8%. Now what do we need to do? We need to use this information of San Van Yu company, and this information, when it is going to be used, it is going to be used for the estimation of what? Estimation of the equity beta, and from the equity beta we'll estimate the asset beta. So we know KE is equivalent to risk-free rate of return plus equity beta multiplied by RM minus RF. So for us to be able to calculate the equity beta, we need to say the KE 15.4% minus the risk-free rate of return, because I'm rearranging the equation, divided by, so you've got risk KE minus risk-free rate of return divided by RM minus RF. Okay, I'll just have to remove the percentages from here. Because there is an inconsistency as to how things are actually going. Number. Okay, 0.154. 0.2, 0.8, make it a number. Okay. So we've got equity beta of San Van Yu company to be 1.33. See, what's actually happening is that we need to talk about the Liviu company, but the problem with Liviu company is that we are not being given the asset beta of motor scooters. We're not being given the asset beta of wind farms. So for the wind farms, we're using San Van Yu company. Now when we have got the San Van Yu company equity beta, so for the asset beta calculation, we need D 1 minus T. We need E plus D 1 minus T. We need all this. So if I say D multiply by 1 minus T, if I say E plus d1 minus t, this is what it is, right? So what happens is that the asset beta is going to be equity beta is going to be E divided by E plus d1 minus t, and this whole multiplied by equity beta. So 1.104167. So what information have we got up till now? What information have we got till now? We've actually got this information. Now, we've got asset beta of Liviu. We've got asset beta of wind farms also. So from this, we could use the asset beta of manufacturing. Sorry, this is asset beta of Liviu. The asset beta of wind is this. Asset beta of motor is question mark, right? So asset beta of motor is going to be equal to this asset beta of Liviu, which is this, minus the 40% of wind has to go there. Then this whole has to be divided by 0.6. So 0.24391. Can somebody else can recalculate and confirm, please? If it is coming out to be 0.24391, can somebody else please confirm? Yeah, can somebody else please confirm? Okay, why have we divided? Because you see, this is the formula. Asset beta is equivalent to 60% into asset beta of motor plus 40% into this. So what have I done? I've simply done asset beta of Liviu, which is this minus this 40% of BAW. This whole is minus because it moves to the left hand side, and then divide this whole by 0.6, the 60%, so you get the asset beta of motor. Okay, I'm just opening up the formula again just for you people to see. Kindly just confirm so that I can move forward then on it. Okay, lovely. So you've got the asset beta of this motor scooters. Now let's move a bit forward. The requirement of the question was we were supposed to estimate an appropriate discount rate to estimate the NPV of on an all equity finance basis. Okay, so what are we gonna do now? We're simply gonna say the cost of equity for all equity finance rate should be based on the asset beta. So risk-free rate RM minus RF is there, the asset beta is there. The risk-free rate is 4.8%. The RM minus RF is this. The asset beta is this. The cost of equity is equivalent to risk-free rate of return plus RM minus RF multiplied by asset beta. So the all equity finance rate should be this 6.751%. This is what the whole answer is. Now I'm just gonna wait for 5 minutes just for you people to have a look at it and see if you understand this. Just in case if any one of you has got any issues, just do let me know. I'll be happy to explain. Yeah, is it okay now? Okay, lovely. So we have been able to do one aspect of the question. What's the second aspect of the question? It says estimate the net present value of the new project, assuming that it is all equity financed. So let's have a bit of a discussion about it. You've got the net project cash flows. So again, I'm giving you 5-7 minutes. Try to calculate the net present value of this project. Okay, so with respect to this, it says that Zichi company expects the new project manufacturing environmentally friendly motor scooters to last for 4 years, right? What do they expect? They expect it to last for 4 years. The project will require an immediate expenditure of $70 million for plant and machinery. After the project ends in 4 years' time, it is anticipated that the project would be sold for $42 million. So what are we expecting? We are expecting the project to be sold for $42 million, inclusive of an inflationary increase. So that means this is at time period 0. This is the residual value. In the following estimates of revenue and cost relating to directly to the project have been made. In the first year, the sales revenue is expected to be this and then increase to 40 million in year 2. In the final 2 years, it will grow by 20% each year. Costs are estimated to be this for the first year and 80% of sales revenue for the second year before reducing to 40% of revenue for each of the final 2 years. Substantial initial working capital of $10 million will be required at the start of year 1. That means at time period 0. Subsequently, working capital equal to 15% of sales revenue for that year will be required. at the start of years 2 to 4. Any remaining will be released at the end of the project. Zichi pays tax 20% every year. Tax is payable with a 1 year's time delay. That means year one's tax would be paid in two, and any tax losses for the project are set against the company's profit from other projects. The tax allowable depreciation is available on the expenditure on the plant and machinery for a project at an annual rate of 15% on a reducing balance basis. It is anticipated that the plant and machinery will have a realizable value of $20 million. At the end of the project, and this realizable value is included in the project's estimated sale price of $42 million. So we have got the relevant information with respect to what the relevant cash flows are for the project, and now we are going to talk about it. We are going to discuss each one of them, that what exactly are they. So estimation of the net present value is what we are going to do. So when you're going to be estimating the net present value, there are multiple aspects to it. Time period 0, 1, 2, 3 and 4. What else do we have? We have got this sales, cost of sales. You could go about doing the depreciation, profit before tax, the tax, and then the depreciation needs to be added back. Gain slash loss on disposal. Investment, working capital, cash flows. Now, what are we simply gonna do? We're gonna say, okay, the sales are expected to be 10 million and then increase to 40 million in year 2. So it's going to be 10 million and then increase to 40 million in year 2, and then it will increase by 20% each year. For the cost of sales, it says they are estimated to be 120% of sales revenue for the first year. And 80% of the sales revenue for the second year. And then they are expecting it to be how much? They're expecting it to be 40% for each of the final 2 years. So we have got costs of sales, different costs of sales. What else do we have? We have a working, we have a depreciation available. Okay. So for the depreciation workings, what are you gonna do? You're gonna say this year depreciation 1, 2, 3 and 4. The depreciation in year 1 is going to be the plant and machinery was how much? $70 million, right? 70 million multiplied 15% is what it is. So depreciation is 10.5 million. And obviously if it is 15%, the next year is gonna be 85% of the previous year's depreciation, then 85% of the previous year's depreciation, and then 85% of the previous year's depreciation. This is how it is going to be. So you would have the depreciation like this. right? You will have the profit before tax. Okay, so you've got the profit before tax like this. Which one is 23 for the year 4? Okay, I'll just come back to it. I'll just come back to it. Okay. What you could do is that you could do a separate calculation for the gain or loss on disposal. You could say the cost 70, accumulated depreciation, the residual value. We are being told residual value is going to be 20 million. Balancing allowance is going to be sum of this, which is 16.5404. So this is what your balancing allowance is going to be. So if we try to do the calculations, this is what it is going to be. Right? Now, then we go on and we talk about the taxation. So if I talk about the taxation, it says the tax is payable after 1 year delay, and any tax losses for the project are set against the company's profit from other projects. Are set off against the company's profit from other projects. That means even if you have got losses, you would get the tax savings onto it. So let me just show you. The tax rate is 20%, right? So minus 20% multiplied by this. This is gonna be year 5. So this is what the tax is going to be. Right now, what would happen is that whatever depreciation that has been deducted, that depreciation needs to be added back. So it will be added back. The investment was 70 million, and we are expecting the investment to be recovered to be 42 million. This 42 million includes the residual value. The working capital calculations need to be done. How would we go about doing the working capital? It says initial is 10 million. So for the working capital, what do you need to do? Here, working capital, incremental. The working capital is going to be, for the year 1, it is needed is 10. For the year 2, we are being told that working capital requirement will be 15% of the sales revenue for that year. 15% into sales revenue for the year 2. This 15% into sales revenue. 15% multiplied by sales revenue. So that means we needed a 10 million working capital. but subsequently this working capital requirement is reduced. So incremental is 10 million. This is going to be, so hence what would happen is that your working capital 10, whatever the remaining working capital is, that would be recovered at the end of year 4. So if you would sum up all of them, this would turn out to be 0. See, 0, the sum 0. The cash flows are gonna be like this. The cash flows are gonna be like this. The cash flows are gonna be like this. So now when we talk about the net present value, it's gonna be NPV bracket. The rate that we have established is this, comma. So $2.14 million is your NPV. And then calculate the tax on the net amount. Will it be correct or not? That's okay, that's fine. Tax saving on depreciation will be added to the next year then. In fact, just wait a bit, I've just made an error, which is I have not considered this year's cash flows. NPV, bracket open, the rate, comma, the cash flows. So it's $0.57 million. That's what the base, that's what the NPV using all equity rate. So this is also called the base case NPV. I repeat, this is also called the base case NPV. Okay, we have already discounted, my friend. This is the NPV function that I've used. See, this is the NPV function that I've used. Right? Okay, now let's move a bit forward and let's take things further. So we have actually completed this, we have completed this. Now we need to estimate the adjusted present value. So for the adjusted present value, we need to see that how the project is going to be financed, then we can go about it. It says financing the new project. Uh, so can you just review it, please? A quick review. Okay, let's just start off. Now it says that due to the positive environmental nature of the new project, Zichi company can obtain the entire funding for the project through a loan at a subsidized rate of 180 basis points. 180 basis points is 1.8%, lower than the estimated risk-free rate of 4.8%. Zichi's normal borrowing rate is 6%. So the normal borrowing rate is 6%. They have decided the project should be entirely funded through the subsidized loan. Issue costs which need to be paid are anticipated to be 3% of the gross finance. Issue costs are not allowable as tax deductible expense. Given that the new project to be funded by the subsidized loan, Zichi's CFO is opinion that the adjusted present value of the project would be more appropriate than the conventional NPV based on risk adjusted cost of capital to evaluate the project. He cannot explain why this should be the case. So anyways, we need to estimate the adjusted present value. So we're going to talk about the adjusted present value and we're going to see that how the adjusted present value needs to be calculated. So for the adjusted present value, need to understand few things. The first thing that you need to understand with respect to the adjusted present value is that there has to be issue cost that you would actually be incurring. So in fact, adjusted present value is your base case NPV plus present value of financing side effects. Now, for the financing side effects, there are multiple, and one of them is actually the issue cost. For the financing side effects, there are multiple, and one of them is actually the issue cost. When we talk about the issue cost, the concept of issue cost is, it says it will be what? It will be 3% of the gross finance. The issue cost would be 3% of the gross finance. Now, what is this gross finance going to be? So I'm just assuming that the entity has sufficient cash to pay the issue cost on their own. But generally speaking, what happens is that when they say the gross finance word, it actually is like this. The finance needed divided by 100 minus issue cost percentage. The gross finance is going to be like this. So the gross finance is going to be the finance needed, which is 70 million, divided by 0.97. That's the gross finance. So the issue costs are going to be 3% of this. So it's actually going to be this into 3%, 2.16495. Next is basically the tax present value of tax savings due to interest. So what happens is that the KD is 6%. The debt, if you take normally, it's gonna be at 6%. The debt, if you take normally, it's gonna be at 6%, right? The tax rate is 20%. The tax rate is 20%. Okay, so basically what happens is that since the tax is arising 1 year in arrear, so interest cost will be 3%. Why 3%? Because we are being told that you will be able to borrow at 180 basis point below the risk-free rate. So interest cost will be 3% multiplied by 70 million the loan. Is equivalent to 2.1, right? The tax savings at 20% is going to be this into 20% is 0.42, right? The tax savings is going to be 0.42. So what happens is that the tax savings will arise from year 2 till 5. Hence, the relevant discount rate at 6% for 2 till 5 will be as under. 5-year annuity factor at 6%. 4.72. 1 year PV factor at 6% is gonna be hence year 2 to 5 discount factor is this. So 3.77 is the relevant discount factor. So this is the calculation. Now, present value of tax savings due to interest will be like this. Will be 0.42 multiplied by 1.58 million dollars. 1.58 million dollars. So this is one of the relevant thing. Now the third one of them is basically, in fact, just wait a bit. There is an extra tax paid due to subsidized rate loan. सर दिया करो मेरे को. Interest expense. So there is an extra tax that is being paid due to subsidy, because you see normally we would have actually paid tax on 6%. See, what would have happened is that, just try to understand. PBIT, let's say if it is 100, if it is 100, if the interest is at 3%, if the interest is at 6%, just trying to tell you something. Assume that the loan was 40, 400. The tax is gonna be like this. If it is at 20%, it's gonna be like this. This into 20%, this into 20%. Hence, what actually happens is that there's an extra tax that's being paid of 2.4. What is that extra tax because of? Just try to understand. So you would actually establish the interest differential of 12, and this 2.4 is simply 20% of this 12. So how would we calculate in this scenario? The interest saved is what? 3% multiplied by 70 million. Extra tax paid is at 20%. So interest saved is what? 2.1 each year. Extra tax paid is this into 20%. So technically what is happening is that if you are having the tax saving due to interest, you are at the same time having an extra tax to be paid because of this subsidized rate loan. The annuity factor for 2 till 5 is again gonna be what? 3.77. Hence, just a minute. Net interest saved is this minus this 1.68. This is the net interest saved every year. Annuity factor is 2 to 5. So you'd simply say, okay, I'll just show you the annuity factor calculation again. See, the formula is PV, bracket open, the percentage multiplied by what value and the time period. This is what it is. And then I've got year 1 PV factor, so I've just deducted and established the net rate. So here you go, the net interest saved is this, the annuity factor is this. So present value of net interest saved is this. 6.34, right? 6.34. Right, what next is there? So if we have to calculate the adjusted present value, it would be like this. The base case NPV, present value of financing side effects, issue cost, present value of tax savings due to interest, present value of net interest saved. Point 0.57. The issue cost is an outflow. Hence, resultingly, this is what it is going to be. 6.33 is your NPV. So 6.33 is your APV, the adjusted present value. Okay, now, is everyone okay till now? Do you want to review anything? Are you stuck somewhere? Yeah, are you people stuck somewhere? Yeah, is everyone okay till now? Please, yes, is everyone okay? Okay, lovely. Seems like everyone is okay with it. So we have got the base case NPV here. Now what next is there? Next situation is we are to evaluate whether the new project should be undertaken. Yes, obviously, because it's a positive APV project. Discusses the assumptions made in the estimates above. Discusses the whether APV method would be more appropriate than conventional NPV method to evaluate the new project. Now, this is something that I would say that it's a bookish knowledge, and every one of you should actually go through this specific part because it is something that's probably going to help you out. So, generally speaking, what happens is that you could talk about the discussion on the assumptions that you have made. Like there could be multiple assumptions, which is maybe the growth rate assumptions are seems to be very unrealistic. The cost of sales reduction over a period of time seems to be very unrealistic. The working capital requirement again seems to be quite unrealistic to be 15% of the revenue because in the initial phase you required quite a lot of it. Then you have got the 100% financing through the subsidized rate loan. Maybe the government may understand your initiative, maybe the government may not understand your initiatives. There could be multiple things out of it. So you got to be probably communicating on that. Then you have got evaluate whether discusses the APV method would be more appropriate than conventional. So it's like benefits of APV over the NPV. Generally, it's the breakdown of the financing element, more risk appropriate rate, more risk adjusted rate. That's what things are. So this is generally what happens with respect to the use of APV as a discount rate. Is that okay to you people till now? Okay, good enough. So we are done with this specific question, which is about the Zichi company. Okay, I'll just go back again and I will ask the questions to you people and see in case if you have got any queries. So I will actually be answering that. I'll start off. Evelyn, do you have any questions to ask, please? You can unmute also and you could just type out. How are you? Very good, Alhamdulillah. Mhm, mhm. Okay, what exactly is the problematic area with respect to collars or straps that you're having? Mhm. Okay, so what I'll just do is that I've got some videos on collars and swaps, which I will just actually, because you see what happens is that if you would have had a specific query, I would have just created a answer right now. But since it's in general, so I've got a detailed video. I will share the video for both of them, video to be shared, right? I'll share a video on both of them. Let me know what other issues do you have. Mhm. Thank you. We've got Faraz Kazmi. Yes, Faraz, do you have any questions? Yeah, Faraz, do you have any questions? Okay, good enough. So you're lacking the practice. So Hassan Lalwani, any questions you have? Salah, I'm really sorry that I could not answer and listen to you properly earlier. You could just unmute when you would want to. I mean, like whenever you would like to unmute, I've allowed you people to unmute. Okay, why did we deduct the depreciation and why did we add the depreciation? Let me just show you something. There are two ways of dealing with the depreciation. What are those two ways? One of them is, let's say you have a profit before depreciation of 2000. Let's say you deduct depreciation of 300. 1700 is your profit before tax. The tax at the rate of 30%, let's say 510, gives you 1190 as the profit after tax, right? And then what you do is that you add back the depreciation to it. 2490, right? Now, let's try to understand. So this is the cash flow that we have got. Now, assume that profit before depreciation, assume the same example is 2000. And I say that tax to be applied on it directly at 30% is going to be 600. Then I would say tax savings due to depreciation. So depreciation was 300 multiplied by 30%, 900, sorry, 90. When you would add up, you would be at the same level. 2000 minus 600 plus 90, right? This is what it is going to be. Do you get it now? You've got both the methods. You can opt for either of them. Yeah, do you get it now? Salah, is it okay for you? Lovely. Okay, now anyone else having any other queries, please? Okay, now let me just guide you. Basically, we have launched the AFM question-based revision session also. That includes only the examination questions. So all the students that who are registered with us, they already get it, but the others who wish to register, they can register in it. We've got the fast track course also. That covers all the core topics plus the exam questions. Plus, we would be upcoming with a mock examination thing also. So you can opt for either of them. And we would be having the revision classes for the examination questions from the next week. It will be twice a week. And in those classes, I would be going through the examination questions. So stay tuned for that. The recording for today's session is going to be shared on the registered students on the portal, plus it will be available on the YouTube also. So you will be getting these recording. Right? Okay, guys. So thanks a lot for being here. Inshallah, see you again in the upcoming revision sessions, which are going to be conducted in the coming weeks and up till the examination date. And please do also be part and parcel of the mock examination. It is going to be very helpful.